All right, let's dive right in. Today, we're talking about two of the most powerful and, let's be honest, often confusing tools in the financial world: futures and options. But forget all the complicated textbook definitions for a second. We're going to break these down and show you what they really are: amazing ways to handle both risk and opportunity out there in the market.
So picture this. You're looking at a stock, let's say ITC, and you've got a good feeling about it. You think it's going to go up. Now, if you wanted to buy a standard lot of 1,600 shares, you'd have to put this much on the table, a cool 8 lakh rupees. That is a ton of money to have tied up in just one single idea.
But what if I told you there's a way to get control over that entire 8 lakh rupee position without actually needing 8 lakh rupees? Yeah, this is where it starts to get really, really interesting.
What if you could control that whole thing with just this, 1.5 lakh rupees? No, it's not magic. It's a financial instrument called a futures contract. And this right here, this is the magic word: leverage. At its core, leverage is just the ability to control a huge asset with a tiny slice of your own money. Think of it like using a small key to start a giant, powerful engine. You can see why this is so attractive, right? So here's the kicker. When you have that futures contract, you're controlling 1,600 shares. That means for every single rupee the stock price moves up, you make 1,600 rupees in profit. Your return isn't calculated on the 1.5 lakhs you put down, it's based on the full 8 lakh value. Your potential gains just got a massive boost.
But, and you knew there was a but, right? This is where we have to be really careful. Leverage is a total double-edged sword. That same power that juices up your gains, it can do the exact same thing to your losses and turn what should have been a small dip into an absolute disaster.
And this is the raw reality of that risk. The source material nails it with this quote. When you're trading with that much leverage and no safety net, you literally can't sleep at night. Why? Because that same 1 rupee move that made you 1,600 rupees in profit can just as easily cost you 1,600 if the stock goes down. And what if it drops by 10 rupees? Suddenly you've lost 16,000 rupees. Ouch. So you're basically looking at two very different paths. Over on the left, you have what's called a naked future. Sure, the profit potential is unlimited, which sounds great, but the loss potential is also unlimited. If ITC stock tanks, your losses could be catastrophic. Now look to the right. This is a hedged future. The profit is still unlimited, but look at the loss. It's defined. It's capped at a number you know ahead of time, like, say, 9,360 rupees. Suddenly, you can breathe again. So, how do we do that?
We do it with something called hedging. And honestly, the absolute best way to think about hedging is to see it as an insurance policy for your trade. It's that simple. You're paying a small fee up front to protect yourself from a financial nightmare, just like you do with your car or your house.
And the specific tool for this insurance is called a put option. Here's how it works. You pay a small fee, which is called a premium, and in return, you get to lock in a minimum selling price for your stock. So if the price just falls off a cliff, it doesn't matter. Your put option is your safety net, making sure your losses stop at that protected price. So how do you actually put this all together? It's really just a simple two-step dance. First, you buy your futures contract, making your bet that the price is headed up. Then, at the same time, you buy a put option to act as your insurance. And what's the result? You've built a position where your maximum possible loss is a fixed, predictable number. No more staring at the ceiling all night. Okay, now check this out, because this strategy has an awesome side effect. Since your broker can see that you've insured your position and limited your downside, they don't need you to put up as much capital. That 1.5 lakh margin we talked about, it could drop all the way down to something like 34,000. So not only did you make your trade safer, you also just freed up a huge chunk of your cash. Okay, we've covered the basics of protecting yourself. Now let's level up. Let's look at a more advanced strategy, the kind that the pros use to really fine-tune their trades. It's called a bull spread. The whole idea starts with a really simple, logical question. We all agree insurance is a good idea, but insurance costs money, right? That premium you pay eats into your potential profits. So what if there was a way to get that same protection, but for way cheaper? And this is exactly how you do it. A bull call spread has two moving parts. First, you buy a call option. That's a bet the price will go up, at a lower price, like 505. In this part of the trade, you're the one who's insured. But here's the clever bit. You simultaneously sell another call option at a higher price, say 510.
By selling that option, you collect a premium, and you basically become the insurer for somebody else. And you can see how the math works out beautifully. Let's say you paid 1 rupee and 85 paise for the option you bought, but you received 1 rupee for the option you sold. So your net cost for the entire position is now just 85 paise. You've just slashed the cost of putting on your trade. It's incredibly efficient.
So what's the catch? What's the trade-off here? Well, by selling that higher option and becoming an insurer, you've put a cap on your maximum possible profit. But look at what you gained. Your cost is limited, your risk is limited, and your profit potential is clearly defined. You've created a neat little package where you know the best and worst case scenarios from the start. No more wild, terrifying surprises. And all of this leads us to the single most important idea of all. As you get more sophisticated, you realize the game changes. It stops being about just swinging for the fences and trying to make a quick buck, and it becomes all about intelligently managing your risk.
The legendary investor Rakesh Jhunjhunwala put it perfectly. He said, option buying empties the pocket, but option selling can empty the safe. Think about that. When you buy an option, the most you can possibly lose is that small premium you paid. It just empties your pocket. But when you sell an option without a strategy, your potential loss is unlimited. A massive market move against you can literally empty your entire safe. It's a powerful warning about using these tools without respect for their power.
And that really leaves us with this final thought. The true purpose of all these clever financial strategies isn't just about chasing some lottery ticket jackpot. It's about building trades that let you stay in the game. It's about making sure you can capture some of the upside while guaranteeing you don't get wiped out by the downside. Because at the end of the day, the goal isn't just to win big. It's to make sure you're still around to play tomorrow.